Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's buying action because once again, all three of the major averages in the green, trending higher for the second day in a row. You're looking at the Dow up 508 points, S&P up just around 1.5%. We're looking at the Nasdaq 100 also up about 1.5%. Some strong results that we got after the bell yesterday from FedEx and Nike. That is what's really driving today's action. Taking a look inside the Dow here, I mentioned the outperformance that we're seeing in Nike. When you take a look at the equal weight performance here, you can see Nike up just about 13% today, followed by Boeing and Caterpillar. Only one Dow stock in the red this afternoon, and that is Walgreens. Taking a look at the sector action again, all green on the screen. Energy by far the leader once again today, up just around 2%. Industrials, consumer discretionary, not too far behind. Materials, the underperformer of the bunch, but up nearly 1% today. I mentioned that outperformance that we saw in Nike, and taking a look at some of those retail stocks, a number of names moving to the upside today. Nike, obviously the clear winner here, but you have names like TJX, Home Depot, Walmart, Amazon here holding on to gains. And taking a look at the bank stocks here, just broadening out just a little bit. Again, green across the screen here with some of the big banks like JP Morgan, Bank of America, Morgan Stanley up pretty significantly this afternoon, Dave.
Nice to have a little hump day rally. Thank you, Shauna. Let's get you up to speed now on a punishing, unrelenting week in the housing market. U.S. home sales, the latest data coming in, dropped 7.7% in November. That's a record, 10th straight month of declines, now to the weakest rate since May of 2020. November sales fell 35% from a year earlier. Mortgage rates, however, continue to slide. The average 30-year fix now sits at 6.34%. That's down from 6.42%, it's according to the Mortgage Bankers Association. Now, that resulted in a sudden bump in refinancing applications. Refis up 6% last week. Big picture, things are certainly declining just about every day, every month, but the median home price, $370,700, is still up 3.5% from a year ago, minimizing that damage. Let's talk a little bit more about that in the broader markets as well with Ryan Dietrich, Carson Group Chief Market Strategist. Nice to see you, sir. It has been, as I mentioned, a brutal week for housing data. What does it tell you about what is to come in the new year?
Yeah, it absolutely has. First off, thanks for having me back. It's nothing new. Like you said, down 10 months in a row, huge drop. What's unique to us, though, is you look at some housing stocks. They've actually had some impressive things to say, and they've been holding in there. So it's kind of a yin and a yang. I mean, I'll tell you what, the economy, we get in all this stuff. The economy to us is likely not going into recession next year because the consumer is so strong. Yes, housing is likely in a recession. Manufacturing's teetering with the recession. So it's a slowdown for sure, but I think it's as simple as, listen, rates have doubled in the past year, or at least 30-year mortgages have. And that's one of the big reasons why that's happening. The Fed wanted this to happen. The Fed wanted things to slow down. So the Fed's kind of getting its wish, I guess you could say also.
Ryan, what about over the next 2 weeks? Because lots of focus here on whether or not we are going to see a Santa Claus rally. We've seen one every year in the last 6 years. We're looking at 2 days of gains. We don't want to get too excited at this point. But is the Santa Claus rally, is that still in the cards?
We think it is. I mean, I think it's one of the more misunderstood things because technically, guys, the Santa Claus rally is the last 5 days of the year, then the first 2 days of the following year. Like you said, up 6 times in a row. All right, it hadn't been up 7 times in a row since like the 60s. But when you get this oversold market like we've had, negative sentiment, now some decent news right out of Nike, and I don't know if FedEx is really even that good what they had to say, but the stock's reacting positively. So there are some things like that consumer confidence. Let's talk about that consumer confidence for a second. I mean, that's a really big jump. Again, one of the big reasons that we're kind of awfully lonely with our call of likely not a recession next year is because that consumer is so strong and that confidence number is a good thing. But to answer your original question, yeah, we think Santa Claus can come to town. These 7 days, guys, are higher about 80% of the time historically. With an oversold market, we think Santa Claus could come to town once again over the next week and a half or so.
When Santa does not come to town, what generally follows and what's the precedent there?
Yeah, that's what a great question, because that's when things aren't so great. We look at the last 5 times Santa Claus did not come to town. January was lower every single time, and some of those years were 2000 and 2008 that we didn't see a strength during the normally seasonal period of strength during the Santa Claus rally. So bottom line, starting Friday, stocks should go higher. If they don't, that potentially could be a warning sign that something's off, something's wrong. Believe me, there's been a lot of things wrong with this year so far. But we do think that October low is the low of the bear market. 6 of the last 17 bear markets ended in October. We know we've given some back, but at the same time, we think that's the lows. And if Santa Claus comes to town, then things should be perfectly kind of more normal, which is a good thing, I think.
Ryan, let's take the scenario where Santa Claus does come to town, because a little bit more optimistic than when we look out into the new year. What are you advising investors out there just in terms of where they should be allocating their money? Is it going to be another year where once again we see value outperform?
Mm-hmm. Yeah, we do like value still. I've come on to you guys all year saying, we're not so warm and fuzzy on technology communications. We've been overweight value. I mean, you showed some of the best performers today. You've got energy and industrials. I mean, those have been leading. We're really impressed with industrials, right? That dollar weakness that we're starting to see, something a lot of people aren't talking about, as you head into next year. The dollar weakness can really be a tailwind for global earnings. We all know this, right? 40% of revenues come from overseas for the S&P 500. A weaker dollar, like we're anticipating, could be a little bit of a tailwind for earnings actually coming better than people think. Nobody's out there saying that. The other thing on this, everybody's saying the first half of the year next year is going to be just really rough. And we get it. We see the same things other people see. Something I don't know people are talking about. 17 of the last 18 times, guys, in a pre-election year. All right, this is back to 1950. That first quarter, so that's next quarter, was higher. That's 17 out of 18, all right? That's the best quarter in a 4-year presidential cycle. The second quarter is pretty good, too. I think I'm open to the idea that we could have a surprise rally the first half of next year with inflation coming back, the economy not going into a recession, and everybody is bearish. Markets have a funny way of kind of surprising the masses when that happens.
China reopening could help in that capacity. You briefly mentioned tech. What about your thoughts on healthcare moving forward?
Yeah, we like healthcare as well. I mean, healthcare's kind of got some defensive and some offensive attributes to it. Bottom line, some solid earnings, just some upward momentum, right? There's some relative strength taking place there. Drug companies, boring old drug companies have done really well also. So healthcare definitely is one of our favorite groups, along with kind of those cyclical value areas. We also like small caps. Haven't done as well lately, I'm aware, but those are some of the areas that when we invest for our Carson partners, our advisors, those are areas we're saying you should look to in 2023 for opportunity.
Ryan, the Fed obviously a key driver in all of this. I guess, what do you think it's going to take in order for the Fed to maybe back off some of their hawkish rhetoric that we have come to expect here since the last couple of meetings?
Yeah, I mean, I think it is as simple as inflation keeps coming back, right? I mean, we're seeing that. Now, I'm aware we had a good inflation data last Tuesday. The Fed came out Wednesday and upset the apple cart. But, another month or two of good inflation data, that could be what it takes for the Fed to take their foot off the pedal. I mean, we've all talked about this, right? Rents make up 40% of CPI. Rents are coming down significantly. If you look at some of the, the private data out there, like Apartment List and Zillow, that's not in the government's data yet. It will be, next 6 to 12 months. So used cars coming back, rents coming back, medical insurance coming back. Some of these things were the reason inflation stayed so stubbornly high, and it is still stubbornly high, don't get me wrong, but now these should be tailwinds. If that could come back like we think it can over the next, we'll say 3 to 4 months, that could be the thing that the Fed could finally say, okay, do that with their hands. Our job is done. Inflation's come back. And that'd be something a lot of people don't expect, but we think it could happen. It could be a good thing.
So, Ryan, I guess more specifically then, how big of a drop do we need to see with inflation? Because it has come back just a bit, but still at 7.1%. So like you were just saying, very high historically speaking, although it has been a bit of improvement since it did peak. Are you talking about another percentage point drop? Do we need a drop to 5%? I guess, what do you think the Fed will be satisfied with?
Yeah, over the next 3 to 4 months, it potentially could drop to the low 5s, right? If we just keep getting 0.1% month over month, if you kind of extrapolate that out. So it could happen a little quicker than people think. If the Fed's going to have another one or two rate hikes, CPI and the Fed's fund rate will be both right around 5% potentially by the time we get to April or so. And that could be kind of that area where they could say to take their foot off the pedal to the metal. Just one more quick comment on this. 15 months ago, the Fed was looking for one rate hike of 25 basis points. Now they're super hawkish. I'm not a Fed hater or a Fed basher. I'm just saying they don't have always the best track record with this. And again, we're optimistic they're going to be a lot more dovish in the next year than they think they are right now.
All right, good stuff there, Ryan Dietrich. Good to see you, my man. Merry Christmas. Just getting started here on Yahoo Finance Live. Coming up, the NFL and Google are reportedly nearing a deal for NFL Sunday Ticket. What that means for the industry. Then, a Tesla investor who sparred with Elon Musk on Twitter tells us what he wants Musk to do to get the EV giant back on track. Also, disgraced FTX founder Sam Bankman-Fried could soon be on his way back to the United States. Don't go away.
Big tech more intent than ever on tackling live sports. The latest has Google on the goal line of a $2.5 billion per year deal for the NFL Sunday Ticket package. Santosh Rao, Manhattan Venture Partners head of research, joining us now. So Santosh, we were waiting for this. This, of course, still according to reports, but Google shares moving on this news today, up nearly 1%. I guess just first, your reaction to this deal and what it means for Alphabet.
Sure. Thank you for having me back. Great to be here. I think this is a great deal. It's a win-win for both. NFL, they get a wider audience. They wanted someone between 2 and 3 billion who can pay 2 and 3 billion. DirecTV did not want to go there. They were paying 1.5. So they get that. This 2.5 billion hasn't been finalized, but I think it looks like that's the number. And that's great. And Google gets to widen its funnel, gets more people in, there's more sticky, and sports is the stickiest content on TV. So I think this is great, and it's great for streaming services. So everything's moving there. And I think NFL commissioner said that he wants to go more and more towards streaming. And this was the inevitable next step. So good. It's a win-win proposition, both sides, and a good deal.
Santosh, what does it mean for linear television?
Well, linear television is on a secular decline. We know they're losing. There's a lot of cord cutting going on. If you looked at the 2Q data, everyone was losing subscribers. So I think that's on a secular decline, and we know that. It's been well telegraphed, and everybody knows that. So it's slightly bad. I think sports is the only thing holding them up at this point, if you ask me. It's sticky, and so they need to spend money there to keep their users. But it's definitely not the best thing. I mean, they're not going away. They're going to be around for a long time. Streaming is just getting started. Still a long way to go. It's the next step down the line. But at this point, streaming is going up and linear is coming down, and that's a fact.
So, Santosh, what do you think this will do for subscriber growth? I guess to what extent do you really see this moving the needle? The latest numbers that we've gotten from YouTube TV showing that they have about 5 million total subscribers. How many more do you think that this deal could potentially bring to the service?
I think quite a bit. I mean, like I said, sports is a very sticky content. It pulls people in. You can really lock people in, increase loyalty, and then you can cross-sell them. So I think there's a lot of stuff going on between the premium service and the YouTube regular service and the YouTube TV. I think you have a lot of offerings right there. So it's going to increase subscribers, that's for sure. Let's see how much. But definitely it's net positive, I would say. It's not going to hurt. Let me put it that way. It's going to grow.
Shares barely moved on this news. Does it mean anything in terms of the investor story?
Not really. I mean, it's a small blip there, but it's more another tool in there to bring people in. So I think that it doesn't hurt. It's not a great needle mover in that sense. But it's going to keep YouTube in the news. It's going to be the talk of the town if there's a big game going on. So it's going to pull people in, that's for sure. And that's what you need. TV is all about stickiness. You're seeing that with Netflix and all the streaming services, streaming wars going on. It's all come down to content and stickiness. You can spend as much money as you want, but if you don't have hit shows and no sticky content, no one's going to stay around. So that's going to be the name of the game, and nothing like sports to do it for you.
Indeed, no question. Santosh, an interesting article in the New York Times today about ChatGPT, which is all about AI, and I believe firmly changing the world in all aspects in which we know it, says that is a code red for Google's search business. How could ChatGPT impact Google's search?
Well, I think the alarm, the alert, or whatever, the red, whatever you call it, I think it's slightly exaggerated. This technology has been there around for a long time, and Google's been using chatbots for a long time. In fact, the underlying technology of ChatGPT comes from Google, as Google themselves. So it's nothing new. But what we saw, the excitement came when they launched this last week, the ChatGPT, and there were 1 million users right away. And it's definitely good, but it's very early, it's still in beta, not ready for prime time, so to speak. Has ways to go. There are issues about accuracy, toxic content, and reputational risk out there because the content may not be correct. So all those things need to be sorted out. There are copyright issues that need to be worked out. But the thought of it's the ultimate promise of AI, artificial intelligence, to simulate the human brain, to act just like that, to get there. I think it's going to take some time, but ChatGPT is definitely a step in the right direction. Let's see how long. It's going to still early, like I said. But it's good. It's a good service. We've tried it, and it gives you a lot of content. But still, like I said, it's not as alarming as people think. And Google is going to spend a lot of money. They've been doing AI for a long time. In fact, their budgets are way ahead of everyone else. So they're going to do everything they can to protect their crown jewel, which is their search business. So they'll do everything. But this is definitely a step forward.
Tell you what, all the kids have it right in their next research paper, at least next year. Santosh Rao, good to see you. Thank you.
Yeah,
coming up,
take care.
Elon Musk told a Tesla investor to, quote, go back and read your old Securities Analysis 101 textbook. We get that investor's reaction next. Shares of Tesla down 65% this year, while CEO Elon Musk is busy engaging in minute-by-minute Twitter trolling. The world's most valuable car company is apparently not fully autonomous. The latest feud between Musk and one of Tesla's biggest supporters, investor Ross Gerber. Elon asking Gerber for his, quote, great ideas, to which Gerber replied, Tesla needs a media and comms team, a succession plan, and some clarity when he'll be back from Twitter. And lastly, that Elon needs to communicate about stock sales, now $23 billion since late April. Mr. Musk then firing back. Go back and read your old Securities Analysis 101 textbook. Popcorn-worthy stuff. Here to respond, the aforementioned co-founder and CEO of Gerber Kawasaki Wealth and Investment Management, Ross Gerber. Good to see you, sir. Your response to that latest barb from Elon Musk.
Well, you know, I spent the night reading my securities analysis book. I figured I would, since, you know, why not, right? And I've got my friend Gary Black over at the Future Fund, who is actually my securities analyst, and he's quite good. And he responded, I think, correctly with actual facts. And we all know that Tesla's down because of Twitter and because of the distraction and unfortunately the brand value that's been somewhat impacted on the short term because of the perception differential between Elon and many of his customers. But really, my goal is really to help Elon. You know, there's nothing more or less than that. I'm an investor in Tesla, and I'm going to stay as an investor in Tesla. And I represent my investors who are invested in Tesla and the Tesla community. And we care about Elon. But when your friend goes astray, you can either be the type of friend who doesn't say anything, or you say something and maybe that person doesn't like it so much, but hopefully he understands that I'm trying to do what's best for everybody. And that's the whole point of all of this, is that Twitter isn't good for him. It's not the right role for him to be CEO. And now I think he's taking the right action, which is finding a good CEO for Twitter and focusing on the technology side of Twitter, which I think he'll do a wonderful job on, and then getting back to really focused on Tesla and SpaceX and all the amazing accomplishments that we want to achieve over the next, year to 5 years.
So, Ross, expanding it out even more, because Elon Musk, in addition to that 101 analysis response, he did break it down a little bit more, because he did say that in simple terms, as bank savings account interest rates, which are guaranteed, start to approach stock market returns, which are not guaranteed, people will increasingly move their money out of stocks into cash, thus causing stocks to drop. I know you're saying that the big issue here, the main issue, is the fact of the distraction of Twitter right now, but you're not at all concerned about rising rates and what that could mean, at least for Tesla's story in the near term?
Well, of course, with all stocks, you get a PE contraction when rates go up, and that's just normal. Whether you remember, Tesla's PE was 100, so a PE contraction would make more sense for it to go maybe to 75 or 60. Now we're looking at a forward PE for Tesla of somewhere around 20 to 25. So part of it, of the decline in all of the stock market, and you can look at the S&P or the Nasdaq as the general index down anywhere from 20 to 30%. A concentrated fund like mine, GK, which owns 40 stocks, is down 40% because we're tech heavy and consumer discretionary heavy. And so when you look at a stock like Tesla down now 65%, one has to accept the reality that this is not market forces creating this decline. And a lot of it, in my mind, is just dilution from the ongoing stock sales in the tens of billions of dollars from Mr. Musk himself.
Yeah, Tesla down more than twice the Nasdaq, down dramatically more than Ford or GM, just for comparison.
And this is while earnings are growing at over 50%. Now, there are many Nasdaq companies where earnings are not growing anymore, and there's a concern. Remember, this is the best performing company in the Nasdaq that's a large cap for earnings growth.
Do you believe that he is, in fact, searching for a replacement as CEO of Twitter?
Oh, absolutely. Absolutely. And I don't think he's having a good time right now doing this. I think it's a real painful process, and he's put a ton of energy and effort into it. And I give him a lot of credit because he dives into these things, and it's super hard what he's trying to do. I get his frustration getting criticism from me. I totally get it. But I care about Tesla first, and I represent, as a fiduciary, my shareholders who have lost tens of millions of dollars in value in what they perceive is because of Elon's behavior. And so, it's my job to try to do what's best for Tesla's shareholders and my shareholders. And, ultimately Elon and my interests are aligned. So hopefully he sees I'm trying to do what's best for everybody.
But Ross, you attribute that dramatic a fall, 64%, strictly to his behavior, nothing to do with demand, nothing to do with having not enough models, a smaller, cheaper EV, as some are clamoring for, what's going on in China. This is strictly about behavior.
Okay, let's be real. Okay, there's EVs are selling like hotcakes right now. I mean, gas prices were $6. Now they finally come down to $5 here in California. When I get on the road right now, there's about 20 brand new Teslas in front of me. There is no issue with selling EVs if you have an EV to sell. Okay, so we've had prices going up in cars and used cars for a long time, along with gas prices were main drivers of inflation. So drivers and people want to cut their cost of living, and a Tesla is the way to do that. There's no change in demand globally for Tesla, not to mention the fleet sales to the Hertzes and the Avises that all want to upgrade to EVs. So this is really where the frustration lies. There's no issues. The biggest issue I see right now is China on the short term because of the COVID policy changes are definitely disruptive. And I expect some disruption at Tesla that'll be very short term. But when you look out into 23, Tesla should have an amazing year. Like new products, Cybertruck, they just launched the Semi. They've totally cornered the market in charging. The business is growing. I mean, it's just an amazing company in every way. And that's why I'm so annoyed, is because the story has changed from what is an amazing company. I mean, we were talking about mega pack production the other day for utilities and what the opportunity for that is. This is a golden era for Tesla. And that's what the focus should be, not, yelling at Fauci because he's weird or something. I don't know.
Well, Ross, what about some of that lasting backlash, though? Because I think many people maybe who had already purchased a Tesla or were thinking about purchasing a Tesla, they now don't want to be associated with that brand because of what has played out over the last several months. I guess how big of an overhang do you see that being, and how long until some of that dust settles?
Well, I say two things to that. One, if you buy an ICE car, you are sending money and supporting Putin in Saudi Arabia. So clearly, Elon's tweeting isn't as comparable, right, to who you're supporting. Secondly, Henry Ford was a Nazi, and it was, doesn't really hurt Ford sales that this is a fact, and this was a fact even back then. So I think people make purchases for a lot of reasons. But what I polled on Twitter, Tesla followers of mine and owners, what I found was fairly surprising was that 60% consider themselves independent. So most Tesla owners are actually independent thinkers, and they're going to make their decisions on their own, irrelevant of politics. So that's the good news. The bad news is our core demographic is generally liberal, and it's generally here in California, actually. And many of the states that are conservative, you can't even buy a Tesla legally. So when you're annoying your core demographic, there is a brand risk, and I think it can be mitigated if it's dealt with now. And that's why I want more PR and comms coming out of Tesla to mitigate maybe the political issues that Elon's now gotten involved with. But I think politics is a bad way to sell cars. And so this is the issue.
All right, Ross Gerber, great to have you here on Yahoo Finance. I know we always love having you back, getting your perspective here on Tesla. I'm sure we will speak with you very, very soon. Thanks so much for joining us. All right, well, coming up, investors are not liking what they are hearing from Rite Aid's third quarter earnings report. You can see shares off just about 17%. More on that when we come back. Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Starbucks, Nike, Rite Aid. Josh Schaefer here to break this down. Help us break all these stocks down. Let's first kick it off with Starbucks. That stock getting downgraded by Jefferies today, although you can see shares holding on to gains slightly, trading to the upside. Now the firm moving to the sidelines on this name, but maintaining its $100 price target, slightly higher from where we're trading today. Warning, though, that the company is going to, quote, tread water for some time. High inflation is one of the big headwinds as consumers adjust spending habits. Now Jefferies expects 7% same-store sales growth in fiscal 2023 and 5% growth in fiscal 2024. Putting this all in perspective, just shy of consensus estimates. Now it has been a little bit of a tough year here for Starbucks in the red year to date. You can see losses off just about 15%. So pretty much in line with the broader market here, Josh, but certainly a concern here from Jefferies that the weakening macro environment could be a challenge for Starbucks, at least in the coming quarter or two.
Yeah, and I thought it was interesting when you look at that year-to-date chart too. Jefferies mentioned that from May up, Starbucks stock has been up about 40% since then, right? So it's a little bit of just kind of a valuation call in the sense of they just think the stock's currently at fair value. And that's sort of what the street consensus is right now too. The street consensus price target is $98.78. Look at Starbucks stock today. It's almost exactly $98.78. So I think people are just sort of starting to level out there that they think Starbucks stock is right at fair value. Now, my play today is a stock that's rising pretty significantly when you take a look here at Nike. It's the best day that the stock has had since June 2021, when shares up about 13%. This comes on the heels of the retailer's second quarter earnings report last night. The company reported beats on both the top and bottom line, with revenue rising about 17% year over year and adjusted EPS besting last year's numbers for the first time in 4 quarters. Perhaps most importantly, though, Dave, the inventory glut may be over at Nike. President and CEO John Donahoe saying, "We believe the inventory peak is behind us." Now, inventory is still sitting at $9.3 billion.
It didn't move.
But they expect that number to come down in the next couple quarters. And they also think margins are going to be fixed here in the next couple quarters. So then you start to wonder, what's the next catalyst for Nike? What are some other things to watch? And I did want to bring this to your attention, an interesting sort of partnership today with Netflix. So Netflix is going to be streaming Nike Training Club. And Shauna, you'll like this too. You guys are both kind of home workout people. Mm-hmm. Nike Training Club, a complete collection of over 90 workouts, over 30 hours of sessions released on Netflix. Perhaps maybe more of an impact on Netflix's stock than Nike's stock. But I think interesting to see Nike kind of getting into that streaming play and pairing up with Netflix here.
That was going to be my reaction, a much bigger impact on Netflix, because one of the problems within there that they talk about is people not spending enough time on the platform, not getting back on the platform each day, only visiting on occasion to watch their favorite shows. They need something sticky, they need something repetitive. And yeah, for those of us that work out every day, they've been doing P90X for 15 years, heck yes, I think this is a tremendous move. Don't know how big it is for Nike down the road, but again, another aspect to satisfy some loyal customers.
Yeah, certainly. I mean, I think it makes sense more so. I totally agree with you guys for Netflix rather than Nike, just in terms of what this could mean for the brand, for the companies going forward. My question, though, is how many people are actually going to use those classes? Like, are you going to try? Because I know you're a Netflix subscriber. You are.
Absolutely,
okay.
yeah.
See,
I'm a little bit more questionable.
I work out almost every day, and I'm not
home?
interested. No.
Oh.
But I do at home sometimes on the weekends, and I don't connect with the TV and working out in that way. I'd rather just do my own workout, write it up, and not do the TV scenario. So I guess I'm just not the right consumer there.
I will do a review. I will report back to you, sir.
Please
Maybe I'll
do.
try it out 2 days.
Please
Okay,
do.
deal. All right, my play is Rite Aid. Shares getting crushed today on the heels of its latest earnings report. The pharmacy reporting a quarterly loss, though a smaller than expected one, and lowered its full-year financial guidance, with CEO Hayward Donegan saying on the call, quote, "We're seeing signs the consumer is remaining cautious, particularly in demand for discretionary seasonal products, which has driven increased markdowns." Now, the primary shortfall for Rite Aid, plummeting demand for COVID vaccinations and testing, as you might expect. They're all seeing that. Shares down more than 17% and nearly 75% this year. Walgreens down, CVS down, albeit slightly. It appears there is some collateral damage here. Look, we are never going back to a time where people are rushing out to Walgreens and CVS for their COVID vaccination. So this is natural. They're going to have to find some way to replace that revenue.
Yeah, certainly. And when we talk about the fact that people are pulling back on their spending, thinking twice certainly about discretionary spending, what that could look like in the coming quarters, those challenges, at least for now, don't seem to be going anywhere, which is a big concern here for the street. A number of analysts lowering their price targets on the stock after these reports. Deutsche Bank lowering its price target to $3 a share. Evercore also slashing its target for the stock. Where we're trading today is right around that all-time low. So at least for right now, things aren't looking too optimistic for Rite Aid, but we shall see. All right, well, coming up next, Kroger and Albertsons and Microsoft Activision are a couple of the big deals we saw in 2022. What might we see next year? We have some predictions coming up. It's been a tough year for M&A as companies put their acquisition plans on hold. Deal volumes in the U.S. plunging by 43% to $1.5 trillion this year amid market volatility and also higher rates. So what can we expect in 2023? We want to bring in Mitch Berlin, EY America's Strategy and Transactions Vice Chair. Mitch, it's great to see you. So are you optimistic that things are going to turn around at least in M&A next year?
We are optimistic, Shauna. Last year, or 2022 will close out at about 15,000 deals closed compared to 2021, which had 20,000 deals closed. It's important to know that 2021 was an exceptional year, it was a record-breaking year. 15,000 closed deals puts us back at where we were pre-COVID, and we're expecting something similar in 2023.
Primarily, what was the factor that crushed the acquisitions in 22?
It was just the persistent inflation, the high interest rates, the cost of capital was higher, but doing deals became more expensive. And so people stepped to the sidelines.
Mitch, when you take into account, I guess, why you're more optimistic looking out into 2023, where you're expecting to see activity, where's that?
Well, we're looking, M&A is always hot in tech. Tech was the #1 sector for M&A for the last 10 quarters, and we expect that to be on the shopping list again this year, because it's not only tech companies buying tech companies, but it's also non-tech companies buying tech companies because they want to accelerate innovation, they want to digitize their business. So tech will still be hot. Large pharma, they have very strong balance sheets. They were very active in 2022. They're going to continue to be active in 2023 and will take advantage of some of the lower valuations. And then oil and gas was hot, and we'll continue to see oil and gas as a dominant player in the deal markets, assuming the commodity prices hold.
How does the regulatory environment impact future M&A deals, in particular the focus on the government trying to block the Microsoft Activision Blizzard acquisition?
It does. I mean, look, last year in 2022, we saw a 30% increase in the deals between 100 million and 500 million. And a big reason for that is that they fly under the radar of the regulators, so they're just easier to close. But we still think big deals are going to happen. There are a lot of big deals in the hopper right now. We see a lot of spin activity. I would say that in the 20 years that I've been doing deals, I've never seen so many spins. There's clearly a spin fever going on right now. We have closed about one new spin engagement a week for the last 12 weeks, and that's unprecedented. So, there are a lot of activity around divestitures and sell side. We think, CEOs are going to continue to get their house in order. They're going to do portfolio analyses. They're going to get rid of their non-performing stocks. They're going to get rid of their non-performing businesses. They're going to shed those businesses that are no longer relevant. And quite frankly, a lot of these CEOs are looking to become pure play companies versus diversify, because it's easier for institutional investors to understand what they're investing in. Yeah. So I would expect to see a lot of sell side activity as well.
Yeah, Mitch, I'm curious just more about the spinoffs, just more, I guess, where industry specific you see that taking place in 2023, because you're right, that was a huge trend in 2022, and it sounds like you're still seeing some momentum in that space.
Shauna, we're seeing a lot of momentum, consumer products, industrial products. We continue to see a lot of activity there. It's not just spins, it's also divestitures. And that's going to continue well through 2023.
All right, appreciate that. Mitch Berlin, EY America's Strategy and Transactions Vice Chair. Coming up, we have the ETF trends you need to know for next year. Stay with us. 2022 was a big year for the ETF market, with estimates putting new assets at over $600 billion, $50 billion in the last week alone. To discuss, we're joined by VettaFi financial futurist Dave Natick for this ETF report sponsored by Invesco QQQ. Good to see you, sir. You have some hidden gems from 2022. Where were they? What were they? What and where were they?
Well, we had over 400 launches this year, which I think is probably a record. That's not a stat that we keep a lot of tight track to, but nearly record inflows, second really only to last year. A couple of funds that jumped out to the team at VettaFi when we started kicking around sort of new launches of the year that we wanted to make sure we highlighted. I'll start with one, which is also one of my picks for next year, which is the Fairlead Tactical ETF. This is TACK is the ticker here. And it's a fairly easy fund to explain. It's a sector rotation strategy. So on any given day, it may be out of energy and into financials. Uses a traditional technical analysis model run by Katie Stockton, a really well-established quant in the space. And this fund is already beating the S&P since it launched in March by about 10%. That's pretty great for a strategy like this. It's a hole in the marketplace. There are not a lot of these actively managed technical rotation type strategies out there. So that's been a big one. And that fits in a world of equity ETFs that honestly got a little wacky at times this year. I mean, this is also the year we got the K-pop Korean entertainment ETF. We got the Happy, the Harbor Capital corporate culture ETF. So a lot of interesting launches out there. I think TAC is a really interesting one that could find its way into a lot of portfolios where people are looking for something that's a little bit more active.
Dave, what are you hearing just from advisors in terms of their outlook next year and whether or not they're more optimistic given the fact that there still is so much uncertainty?
Well, honestly, I think advisors are a little less optimistic than consumers. We've had some good improving consumer sentiment numbers. The advisors we talk to are still positioning defensively. Now, that doesn't mean they're running to cash, although we've had record bond inflows over the last year. What it means is they're looking at the equity portion of their portfolio and looking to add either a quality spin to it, a value spin to it, or increasingly a dividend and income generation spin to it. I'll highlight JEPI, the JP Morgan Equity Income Fund, one of the best performing and highest asset gathering funds over the last year. But that lives alongside really traditional things like SCHD, which is Schwab's dividend strategy, the fifth largest asset gathering fund this year. And it's pretty dirt standard buying dividend paying stocks. That's a really interesting way for people to get a little bit more defensive than they might otherwise. We recently had a pretty interesting ESG spin on that, the SNPD, which launched pretty recently, I think just in November, for folks looking to do something a little ESG with their dividend strategy. But a lot of advisors positioning for that cautious but not running to cash portfolio.
David, how did geopolitics impact your outlook for 23?
Well, I think we have to acknowledge that this has been a crazy year for the U.S. versus the world when you think about investing. The run-up we've had in the dollar has made it really tough to be internationally diversified. But good advisors, smart portfolio managers recognize that a core piece of your portfolio needs to be an international exposure. How do you do that with the geopolitical stage as chaotic as it is? Two funds I'd look out right there. One is if you're looking for traditional sort of developed markets exposure, I'd look at DMCY. It's the Democracy International Fund. What this does is it reweights the global markets ex-US based on how democratic they are. That's actually turned out to be a market-beating strategy for for the developed part of the market. And for the emerging markets part, we've had a great fund for a few years here, FRDM. It's the Freedom 100 Emerging Markets ETF. It's actually beaten the pants off pretty much anything looking at emerging markets because it's avoided China and it avoided Russia going into the war. So both ways to think about your international exposure and maybe avoid some of the worst geopolitical concerns.
So Dave, we know what you like. We know where you're seeing opportunity for next year. If you had to tell investors one sector or maybe one fund that they should avoid, or maybe now's not the time to buy in, what would that be?
I think you need to be skeptical of TIPS products right now. Now, TIPS themselves can be interesting. We're at a point now where I think the 10-year break-even is about 2.5%, meaning that inflation has to really run hotter than that for 10 years for it to pay off. That seems like a reasonable bet to a lot of people. The problem is tips in a portfolio of other bonds can be really problematic. So if you're looking for inflation plays, I'm not sure you should be looking at the bond market based on what we've got going on over the next year. I'd be looking at things like more cyclical equities, maybe rolling back into some of the parts of the market we expect to respond positively to continued inflation. That could be things like financials, for instance, which have been benefiting from the higher rates.
All right, great advice there. Dave Noddick, always great to have you on, of Verify Financial Futurist. All right, well, coming up next, we're counting down to the closing bell. Just about 8 minutes until we ring that bell. Dow off the highs of the day, but holding on to gains up just 438 points. We'll be right back. Minutes away from the closing bell, Jared Blicker has a closer look at some of today's big movers, Jared.
That's right, Chinese stocks, and I'm not seeing any particular fundamental driver here, at least not in the bigger sense, having a banner day. Some of our big leaders today are in the Chinese space. We got JD.com up 3%, Baidu up almost 5%, NIO up over 4%. I was just looking over our EV board too, and when you look at some of the outperformers like XPeng, that's up 10%. Again, getting back to some of those Chinese names, and let me just show you what's happened over the last 2 months here. We've seen a big pickup in this space, and a lot of that has to do with easing restrictions from the Chinese government because of COVID. But nevertheless, this has almost been an asset class unto itself this year, as it's behaved quite differently from a lot of other things that we focus on. Well, getting back to some of the U.S. tickers, we want to take a look at Carnival Cruise Lines. It is up almost 5% today, and that is after reporting a fourth quarter loss per share, slightly narrower than what the street has expected. Also, they reported strong booking trends into year end. again. Vital Knowledge pointing out, however, quote, it seems that every quarter CCL posts lackluster results while speaking positively about demands and bookings and promising better things to come. This time around, it's right into that pattern. So taking a look at year-to-date results for this stock, you can see it's been kind of a rocky road, ending right now. If the year were to end, it would be down about 57%. And you can see having made a lower low towards the end of the year in September, October, with some of the indices, been kind of a rocky area for stocks. All right, now we want to get to our apparel section, and that's where Nike. We've been talking a lot about Nike today. Some banner earnings. You can see that stock is up 12%, best day in months. And this is after showing that it can execute through a tough macro environment. NKE stock having its best day in a year and a half. Check out what shoe and apparel stocks are doing besides Nike today. And here, let me sort by performance so we can see some of the winners here. Foot Locker up almost 10%, Puma up 9.5%, Crocs up 8%. So really a banner quarter for Nike. Just wondering what you're seeing, Dave. I know this is a stock that you follow closely.
I was a little surprised by how good a day Nike had, just because they hadn't worked through the inventory issue. I don't know about you. I mean, it had stayed almost exactly where it was the prior quarter. But yes, the demand is there, the sales are there, and that's why you can see Dick's Sporting Goods and Academy and Lulu and Foot Locker, even though they're getting away from their dependence on Nike, the whole sector benefits.
Yeah, I think a lot of it also came from the earnings call, just in terms of the guidance there, what they're expecting to see, the type of improvement they are expecting to see in inventory levels over the coming quarters. It was also interesting just looking at Wall Street's reaction, not so much the stock price, but really what we have heard from analysts today, because a number of them were very positive on the results, despite the fact that inventory levels have remained so high. Morgan Stanley raising their price target on the stock to $138 a share. Piper Sandler also raising its price target, citing some of the progress that the company has made to a, quote, clean inventory position. So I think they still have work to do. That's the general consensus, but baby steps at this point.
A lot of markdowns through the holidays, but a lot of those analysts like the digital side of the business. They can track exactly when and where and why their consumers are buying Nike shoes.
It's a really impressive story that they're pushed to the consumer here, really finally paying off and helping in terms of their margins. Here's a look, by the way, of the entire Dow, and here's Nike down here with that 12% return. Caterpillar up over 2%, also Boeing in the mix here. Pretty banner day for the value and cyclical stocks in this index. And with just a few seconds ago, let me take a look at the Nasdaq 100. I talked about some of the Chinese stocks, but also check out the chip stocks. AMD up 4%, NVIDIA up 2.5%. Here's your closing bell.
All right, there's your closing bell on this hump day. Let's check out the numbers. We did finish in the green again. Nice bounce back day for the Dow, 526-point gain, 1.6%. The S&P also on a roll, gaining about 1.5%. And check out the Nasdaq. Perhaps Santa Claus is indeed coming to town. 1.5%, 162-point gain. For a closer look at the broader markets, let's bring in Jim Caron, Chief Fixed Income Strategist at Morgan Stanley Investment Management, and Dan Pipitone, co-founder and CEO of Trade Zero. Nice to see you both. And Jim, we'll start with you. What do you make of today's rally?
Look, I think it's a nice reprieve from what we've been seeing. And, I go back to some of the risks that did come into the marketplace, which was, obviously the Fed, potentially for the Fed to move interest rates up to 5 to 5.25%. And I think what the markets are starting to realize is that, we may be able to get through some of this. It's certainly going to be bumpy, but I don't think that it's a risk-off environment. At least it doesn't seem like Fed policy, even though it's supposed to move up towards 5%, is going to be an extraordinary tightening of financial conditions. And I think a lot of people are pricing in bad outcomes for the first half of the year. And to the extent that we outperform those outcomes, that could be a positive, and that could be, potentially what's behind some of the technicals and seasonals that go into the end of the year.
Dan, what do you think? What do you think today's gains, I guess, are signaling just in terms of what we could see in the coming weeks?
I think, Santa Claus rally, not sure. Is this a reaction to what we've seen over the last month and a half? Have things really been beaten down? Or is it, really a sign alluding to what Nike reported today in their earnings numbers and what they're guiding to as to maybe this being a much better holiday season than we anticipated coming into it. And the Dow rally today, I think, is reflective of that. Moving into the first quarter, we are seeing some headwinds continuing, especially in the retail trading space, where we do believe interest rates will peak out 5.5%, sort of the middle of next year, with some relief thereafter.
Yeah, Jim, a nice bounce for Nike and for FedEx coming off their earnings reports yesterday. How indicative are those two, generally pretty decent bellwethers of the economy in terms of what's coming next?
Well, look, I mean, I think the consumer is still in reasonable position these days. Wages are still reasonably high. I mean, they're coming down, but they're certainly not collapsing. The labor market's very strong, even still. So people are making money. Incomes are there. I mean, wage inflation is still running somewhere around 5%. There's shortages in the service sector of the economy. So I think in that sense, the demand to spend, whether it's Nike or other consumer related assets, I think I think it's there. I think it's absolutely present. And we can't really underestimate the consumer right now. And don't get me wrong. I mean, it is weakening. I mean, things are slowing down by design, but it's not collapsing. And I think what's been put into the prices, or at least the sentiment going into the next couple of months, is probably something more negative than what the markets may actually deliver, or the economy may actually deliver, really.
Dan, you have a strong look, or a good look, I should say, at the retail investor right now. What are you seeing just in terms of activity, given some of the uncertainty that we're up against?
These 2022 is not 2021, clearly. The second half of this year has definitely been challenging with respect to retail trading volumes. And while we are still seeing retail actively engaged in the markets, I think they're just doing a lot less than they have in the past. And so Santa Claus rally or not, we are looking at some headwinds coming into the first quarter, and really retail navigating stories that they haven't really been privy to the last couple of years. Recession talk, rising interest rate environment, choppy markets, things not moving only in one direction. So once we ride out the first quarter on into the second, we do believe that volumes will start to pick up again.
Jim, you write of a, quote, real fat-tailed risk lurking in 2023. What is that?
So I think there are two of them. I think to one degree that we could be in a situation where inflation picks back up, and we're not going to know that until the end of next year, or at least towards the third or fourth quarter of next year. And if that happens, then the Fed may have to restart their hiking cycle. So that's a tail risk. I mean, that's certainly a risk event. But the other risk event that's out there too, which I also consider a risk, is if things don't slow down enough and that asset prices rally beyond what people actually think. Many people are not priced for that either. And I think they're going to be forced to chase returns. So the two fat tails really suggest that there's a decent probability that you could go in either direction. So what that tells you is that as we sit here right now, we can expect higher volatility going into 2023, just because it's so uncertain as to which way we can actually go. And I think that the events, particularly if inflation doesn't become anchored, goes down but doesn't stay down, and that brings the Fed back in, I think that could be a very negative outcome. And that's certainly a risk case, not a base case. But the other risk case out there is that we just don't get the slowdown, that everybody's anticipating, and that asset prices stay relatively high and people miss it. And then they're forced to chase at really bad levels. And that creates a bad technical for the market and makes us due for a correction if that's to occur. But again, that's probably sometime in the first half.
Dan, it's always extremely tough to time the market. We hear time and time again, you shouldn't try to time the market. But for those retail investors that are looking to get in right now, where are you seeing, I guess, what is your advice just in terms of where they should put money to work? Sure. Well, what we're seeing actually is sort of a pivot in the retail trader where, there were essentially two strategies that folks would follow for the last couple of years, picking those stocks that they were really enamored with on the long side, and then actively day trading some of these, small and mid cap intraday gappers, which those two things still exist.
But what we're seeing now is that folks are building portfolios, a lot of times anchored in these beaten down tech names, and then trading around those portfolios. So from our perspective, we really focus on the active retail trading segment. We are seeing now folks kind of rein the activity in a little bit while building portfolios and leveraging their investments more while they're trading around those portfolios.
All right, Dan Pipitone, Jim Karen, always great to have you. Thanks so much for joining the program here. Well, coming up, Ukrainian President Zelensky is at the White House and will address the U.S. lawmakers in person tonight. We'll tell you about it. And Sam Bankman-Fried could soon be on U.S. soil. We'll have the latest on his extradition coming up.
President Biden and Ukrainian President Vladimir Zelensky meeting today at the White House. This Zelensky's first trip to the U.S. In fact, first trip out of Ukraine since the Russian invasion in February. He'll address a joint session of Congress tonight. Senior columnist Rick Newman here with what's going on today between the two. Rick, good to see you. What are we learning?
Well, I was wondering what he would wear. I guess it might sound kind of silly, but I was wondering if he would stick with that combat uniform, you know, the olive drab clothing he's seen in all the time, or he'd put on a suit. Nope, you can see him there with Biden. He's wearing his combat duds. And Zelensky spoke in English, unscripted, without notes, in the meeting without Biden. He expressed his gratitude for the White House support and for the support of ordinary Americans. That was the phrase he used. And later on tonight, as you mentioned, Dave, he's going to address Congress. And I think there are a couple obvious things going on here. First, the United States, the Biden administration and Congress are giving Zelensky a stage, one of the most coveted stages in the world. Surely Russian President Vladimir Putin won't be happy about it. But there's a lot of money at stake here, too. Now it looks like Congress is likely to approve another $45 billion for aid to Ukraine in this bill that they're going to vote for sometime this week. That's more than President Biden wanted. Biden only asked for $38 billion. Congress plus that up to 45. And I think another part of the strategy here by Zelensky and by the White House is to get some rah-rah momentum going among Republicans who have said that when they take over the House next year, they may not be so eager to support Ukraine with money. And there's some voices within the Republican Party that aren't so happy about all the money the United States is spending to help Ukraine. But as it is right now, it's an important moment for Zelensky, especially as this war just continues to drag on.
Yeah, that's going to be an interesting road ahead for Republicans, to be on the side, or if you're against Ukrainian aid, then de facto, Rick, you're on the side of Russia. How are they going to split that gap?
So this $45 billion we're talking about, this would be more money than Congress has already appropriated for Ukraine for this year. And basically, it would be meant to get Ukraine through much of next year. I mean, this is all based on the government's fiscal year, which ends September 30th. But $45 billion is a lot of money, and that will go a long way through 2023. And then, it really becomes a matter of public opinion, Dave, and it's true in Europe as it is here. Whether government support for Ukraine begins to fade depends on whether public support for Ukraine begins to fade. I think this is something Americans should actually feel good about right now because there's pretty strong support for continued aid to Ukraine. Americans, for the most part, think we're playing the right role by helping with equipment, weapons, and not sending troops there. And the way I look at it is Ukraine's army is basically fighting one of our largest adversaries on our behalf, Russia, inside Ukraine. So I've written that that's actually a pretty good deal for American taxpayers, and American taxpayers seem to feel that way so far. So I think the important thing is just keep that momentum going and make sure people just don't get Ukraine fatigue or war fatigue.
Yeah, strange time, though, probably to start fighting for fiscal discipline, but we shall see. Rick Newman, good stuff. Thank you.
You did.
All right, disgraced former FTX CEO Sam Bankman-Fried may soon be trading the sunny shores of the Bahamas for the chilly streets of Manhattan. David Hollerith joins us now with what's ahead for SBF. David.
So, Dave, we can now, I think, confidently say that the incarcerated former CEO of FTX is headed back to the U.S. Earlier Wednesday in a Bahamian court, a judge approved the decision for Bankman-Fried to be extradited, and this followed Bankman-Fried's choice over the weekend to reverse an earlier motion his legal counsel had raised objecting to extradition. There was some confusion amongst his legal counsel on Monday during a hearing, but the latest development today solidifies that the former billionaire will stand trial for criminal charges in the U.S. Now, the final step for getting him airborne out of the Bahamas is for the Bahamian Minister of Foreign Affairs to sign off. Sources in the Bahamas tell us that the minister has filed his papers. Bankman-Fried is still being held in custody in the Bahamas, and for security reasons, the time of his departure today and arrival in the U.S. by federal aircraft hasn't been disclosed. A spokesperson for Bankman-Fried has declined to comment on the situation, but can add that his case, while the docket has not become public, his case for criminal charges in the U.S. Has been assigned to a former Manhattan district judge.
Meanwhile, David, another one bites the dust. One of the biggest publicly traded crypto mining companies in the U.S. filing for Chapter 11 protection. What do we know?
Yeah, so Core Scientific, the public miner, they cited the plummeting price of Bitcoin along with rising electricity costs and difficulty receiving payments from clients that use its facilities. Now, Core Scientific did first raise concerns of bankruptcy back in October. It told investors it wouldn't be able to meet its debt obligations, while also alleging through a separate legal complaint that a customer, Celsius Network, owed it several $1 million. Now, whether that's proven to be the case or not regarding Celsius, Core Scientific joins more than a handful of other crypto firms, including Celsius Network, that have filed for bankruptcy since July. The company which went public by SPAC last year, reached a peak market capitalization of $4.3 billion. It now owes at least $894 million in debt obligations, probably more, to its lenders, including MassMutual, B. Riley Financial, NYDIG, and another bankrupt crypto lender, BlockFi. So to pay for legal fees through the bankruptcy process, Core Scientific does plan to continue mining Bitcoin. That's what we have at this point.
Boy, trust in the space continues to disintegrate. David Hollerith, thank you. Coming up, while some companies have been struggling, been feeling the pain from the strong dollar, it's been helping some luxury retailers. We'll tell you about the luxury consumer next.
Consumer confidence bouncing back today, reversing 2 straight months of declines. Now, consumers appearing more upbeat on business conditions and the prospects for income. But how do those beliefs, though, translate over to the luxury consumer, which we know has been pretty resilient throughout the year? Joining us now for more on that, we want to bring in Pauline Brown, former LVMH chairman of North America, also author of Aesthetic Intelligence. Pauline, it's great to see you here. So luxury consumer has been extremely strong up until this point. One of the bright spots in the broader economy, high hopes heading into the holiday season. Has that come to fruition? Is the luxury consumer still thriving at this point?
Well, thriving would be an overstatement. I would say relative to the broader consumer, they're very healthy, especially at the ultra wealthy end. You know, luxury is really divided into 2 subsegments. You have the true luxury consumers, the ones who, you know, are part of your core customers, the ones who come back, the ones who have, in many cases, generational wealth, multi-generational. And then you have a big pocket of what we call aspirational luxury consumers. And they are not immune to what's going on. They're not immune to inflation. They're not immune to some of the economic uncertainties that are ahead. They're not immune to housing prices. So I'd say that segment of the market, and that tends to hit more of the accessibly priced luxury brands like a Michael Kors or a Tapestry. That side is not nearly as healthy as we would like it.
And where are luxury sales in comparison to a year ago, and also in compared to prior pre-pandemic?
So overall markets, is up over 25% versus 2019. And even in the last year, it's grown on average, depending on the brand, depending on the segment, but I would say high teens, mid to high teens for most of the players. It has tempered off toward the end of the year, but it's still growing and significantly outpacing what we see with general consumer growth.
Primarily, where is that growth? That is a massive number compared to pre-pandemic.
Yeah, well, it's spotty. So a few years ago, for example, even as recently as 2 years ago, I would have said the bright spots are handbags, are very high-end sneakers and other areas of footwear. Those areas have decelerated. What has taken off in the last year, which shouldn't be a surprise to anyone who either went to a wedding or is going to a holiday party now, is what we call occasion wear. So there was a period for about 2 years where evening wear, where special outfits for big events, including for travel and other upcoming to-dos, that completely fell off. And that has come back with a vengeance. But I think some of the other segments have leveled off.
Pauline, any insight in terms of who is spending right now, generationally speaking? Because Morgan Stanley was out with a pretty interesting note a couple of weeks ago saying that Gen Z is actually responsible for a lot of the spending that's happening in the luxury space. Is that consistent with what you're seeing?
Not so much. I think it depends again on the segment. Gen Z does drive a lot of the beauty growth, which is more of an accessibly priced luxury item. They're driving a lot of the resale business, and they certainly are going to move more and more into luxury. But as some of the technology sectors have gone down, most Gen Z don't have the means to be your core customer. The best you can hope for is that you can create the desirability, and you can maybe sell some of the more accessibly priced items, and then you can sort of grow them into the business over time. And I don't think that has changed.
International issues, both the strength of the dollar and the China COVID lockdowns, which have recently reversed. What's been the impact?
Well, that has had a huge impact. During COVID, while people weren't in stores, they were shopping and they were spending money that they normally would have spent on travel or in restaurants on products. But they were at home. Now travel, and particularly luxury travel, is one of the fastest growing segments. It is about twice the volume of what it was already in 2019. So if you look at, and we can see that even from the price of airline tickets and better hotels and the scarcity of them. So, and I think in particular, American travelers to Europe is where we see one of the biggest spikes. And what happens when Americans go to Europe and the European currency is as relatively cheap as it is right now, they do all their shopping there. So we're seeing a huge shift in where people are buying. A few years ago, I would have said all of European luxury goods was propped up by Chinese tourists coming there. Now you don't see that, but it's largely American tourists. And unfortunately for the American luxury retailers, they are paying a price.
Pauline, there was a recent CNBC survey finding that millionaires are planning to cut their holiday spending due to inflation. When we take that into account and look out into 2023, I guess how worrisome could that trend potentially be for this sector?
Yeah, I don't see that at all. I mean, I guess it depends where we cut off, where we is the millionaire the person who has a house that's worth 1.2, but is maybe only making 100 or 150,000 a year. In that case, I could see it being a concern. But for people who have in liquid assets in the millions, travel has really regained momentum above and beyond what I would have expected. And I don't see that leveling off just yet.
No sign of that.
At least on the leisure side, I should say. Right. Business travel has changed its nature altogether.
No question about that. Maybe forever. Pauline Brown, good to see you. Thank you.
Thank you.
There will be no Black Adam sequel, according to Dwayne "The Rock" Johnson, who tweeted that Black Adam will not be in the first chapter of the new DC universe. Yahoo Finance's Ali Canal here with the latest on this. Why? Presumably sales.
sales, and also the DC universe is going through a reckoning period, right? We saw James Gunn, Peter Safran take over that universe at the end of October. And since then, there's been a lot of scrap projects, not just the sequel to Black Adam, but also Wonder Woman 3 no longer in production. Henry Cavill, he will no longer return as Superman. That created quite the uproar. In fact, James Gunn went on Twitter shortly after that news broke saying, quote, "Disrespectful outcry will never ever affect our actions." You can only imagine the types of DMs he was receiving on the heels of that news. But specifically to Black Adam, this was a passion project for Dwayne Johnson. He was attached to this role 15 years ago, and since that time, his star exploded. So in 2017, he used his influence to convince Warner Brothers to create this movie with Black Adam as the star, the title character. He would play it, but it just did not resonate with fans. It did not connect at the box office. It received poor reviews. So I'm not really surprised that we're seeing the sequel be scrapped, because it seems like DC, there's a lot more work to be done. There's a lot bigger fish to fry. If you're a fan of this universe, this franchise, you know that it's been a hot mess. So I think only time will tell. We'll see in 2023.
We will see, although I would think that there are some fans that are a little bit disappointed about this. Allie, we want to switch gears here a little bit and talk about music, because Justin Bieber reportedly the latest musician here to sell his music rights. And if these reports are true, he's getting a pretty good payday out of this.
Yeah, he's eyeing a reported $200 million deal to sell those rights to Hypnosis. That's a Blackstone-backed investment and song management company. And if this deal goes through, that will be the largest acquisition for this company. Earlier this year, Hypnosis purchased the rights to Justin Timberlake's song catalog for a reported $100 million. And it's interesting to see some of these younger artists go after these types of deals. We've seen this from the older generation. For example, Bruce Springsteen in December 2021 sold both his master recordings and publishing rights to Sony Music in a deal worth north of $500 million. We also saw the Red Hot Chili Peppers, Bob Dylan, Stevie Nicks, all north of $100 million. That Bob Dylan deal, 600 copyrights for $300 million. And it's just because we're in this streaming environment that's ballooned the value of a song and an album. Although I will say, now that interest rates have risen, buyers are having a more difficult time financing these types of deals. So we saw this explosion throughout the pandemic when we had ultra low rates, but now perhaps we'll see that activity slow. Maybe it could affect the Bieber deal, although he's such a huge artist. I don't
and has been for 20 plus years, going strong.
He's 28, $200 million.
They call themselves
The Believers.
Believers, I know.
Yes.
Something
He's
like
only
that.
28?
Yes. Only 28. He's pretty young. I know. He made a heck of a lot of money in that short amount of time. All right, Allie Canal, thank you. Well, coming up next, credit card rates are at their highest level that we have seen in decades. Our next guest tells us what users need to know heading into the new year. Stay tuned.
It's beginning to look a lot like a frigid, sloppy, ugly Christmas for travelers. No, that's not much for song lyrics, but the bomb cyclone is expected to impact tens of millions of Americans over the holiday weekend. Brian Kelly is the Points Guy founder, joins us with tips on how to navigate this wicked weather. What are we supposed to do, man? Tell us, we need some advice right now.
Well, my tip is get out of Dodge as soon as possible. The airlines are offering weather waivers, so if you want to delay or leave early, you can do that free of charge. So, yeah, basically you got to plan ahead because, we saw this summer, even thunderstorms set off chaos in the airline industry. We haven't seen the mass cancellations happen yet, but, the aviation industry's pretty distressed as it is. So anything can kind of throw it, for a loop.
Brian, what do people do? Because so many of your followers, I'm sure, book their travel with points. If you booked your flight with points and it gets canceled, are you at a disadvantage? Or I guess what are some tips that people can do if they unfortunately find themselves in this situation over the next couple of days?
Yeah, well, actually, you're not at a disadvantage. You'll get all your points back. And remember, if an airline cancels your flight, even for weather, they owe you a full refund, whether you paid points or you paid with money. A lot of times they'll try to offer you vouchers, say, no, give me the money. Where I actually think points come into play, though, if an airline cancels your flight, you're stranded at the airport, that airline has no obligation other than to get you on the next available flight, and usually just on that carrier. What you need to do is book yourself, get proactive. Sometimes there's only one seat left on the next flight out. Be as proactive as possible. Don't wait in that 2-hour line waiting to speak to a rep. Rebook yourself. Use those frequent flyer miles. A lot of times last minute, same day travel, you can redeem miles for great value. So, and if you're really like me, I sometimes will have a backup reservation using points on another airline. So if my original flight gets canceled, I've got a backup option. My original flight takes off, I just cancel the points reservation, I get all my miles back.
Wow, that's a lot of effort, though. I'm flying with the family of 5 on Christmas morning. We're just gonna take our chances. We got our waiver. Broadly speaking, credit rates now at their highest rate in 30 years. That's according to Bankrate. Can we expect any relief in that capacity into the new year?
No, interest rates are going up. Consumer debt is going up. And if you're going to play the points game, I cannot stress enough how important it is to pay these credit cards off in full every month. The points you get in value will be completely outweighed by the interest you pay. So if you're going to play the points game, you've got to be maniacal about paying those bills off.
Brian, what are some important things that people should keep in mind given the fact where credit card rates are right now? If they're thinking about getting a new card in the new year, what's maybe the 2 or 3 things that they need to consider?
Yeah, first thing, if you're in debt, just try to, the number one thing to increase your credit score is to pay down your balances. So instead of getting a travel credit card that might offer you a sign-up bonus, you might want to neutralize that APR and go for 0% balance transfer. Also, but the thing is with the points cards, there's a lot of ways now you can earn points by using credit cards. There's a Built MasterCard that won our best no annual fee card. There's no fee to pay for it and no fee to earn points on rent for the first time ever, which was in our Reader's Choice Awards. So, get credit cards that reward you for what you're spending on.
Yeah, you've got both Reader's and Editor's Choice in terms of some of your favorite cards of the year. A few more of those and why, what distinguishes them apart?
Yeah, the Capital One Venture X card won our all-around card of the year. Some people will say, well, it's $395, but you automatically get $300 a year in free travel plus 10,000 miles, which are worth, conservatively $150. So you're getting more in value every year via the perks. And I think that's the key theme. The Points Guy readers, we are traveling. We want perks and points. So sometimes it might make sense to pay a heftier annual fee to get really amazing perks like airline elite status, hotel elite status, so that when things go wrong at the airport, the airlines take care of their elite members. And that's why so many people nowadays are getting those airline credit cards just to get the elite status.
Brian, what about people who want to go in on a credit card when it comes to one specific hotel or one specific airline? What's your advice there?
Absolutely. So generally the airline and hotel cards are good for perks, right? So the best new and refreshed credit card was the Marriott Bonvoy Brilliant card. That's going to get you an 85,000 point room each night you have the card. And just to put it in perspective, what does that mean? You can get $1,000 night at the St. Regis, New York for that. So you're going to pay $650 for a card where just that one perk alone can get you more than that in value. Plus you get Marriott Platinum status, which gets you all sorts of upgrades. So, the hotel and airline cards are good. I wouldn't recommend putting all of your spend on them because you want to diversify. The best overall credit card that our readers voted on was a Chase Sapphire Preferred. It's $95 annual fee. And those programs allow you to transfer to a number of different airlines and hotels. So kind of like your stock portfolio, you want to diversify and have a points program that allows you to transfer points to a number of partners versus boxing in with just a single airline or hotel.
I was searching for that no annual fee. If corrected my thinking there, Brian, what are some of the trends you're watching in terms of credit cards in 23?
Well, there's all sorts of new credit cards coming out that I kind of find exciting. There's a lot of innovation happening in this space. There's even a new credit card that will, for the first time ever, you get rewarded for fitness. It's called Paceline, and the sign-up bonus is an Apple Watch. And every week that you hit your activity goals, you earn elevated rewards. So we're going to start seeing a lot more. There's even a lot of niche credit cards are coming out. So Cardless is teaming up with Simon Malls. They're coming out with their own co-branded credit card. So lots of innovation happening, lots of niche card products that are meeting consumers wherever they are in life. It's not just travel rewards that we're seeing all this action.
All right, points guy Brian Kelly, safe travels. Merry Christmas, my friend. Okay, Shauna, what's moving after hours?
We've got three names for you here, Dave. We have Micron, Under Armour, and Miller Knoll. Let's start with Micron. You're looking at losses of just about 1% in extended trading. Weak forecast here. That's a big reason why the stock is moving to the downside. Sluggish demand during the quarter. The company also announcing some cost-cutting plans. They're looking to reduce their headcount by about 10% over the course of 2023. For the first quarter, though, their most recent quarter revenue missing expectations, off about 47% on a year-over-year basis. Also, gross margins coming in a bit light. Executives in this earnings release saying that Micron is taking decisive actions to cut supply and also expenses. We are looking at gains over the last 3 months, but year to date, it certainly has been a loss here for Micron so far this year, with shares off about 45%. Let's take a look at Under Armour because a new CEO has just been named for the company. Stephanie Linnartz has now been announced as president and CEO of Under Armour. This is effective as of February 27th. And now Linnartz was most recently president of Marriott International. So when she does join, of course, this concludes that 7-month search that we have been talking about when it comes to Under Armour looking for a new CEO. Colin Brown, who has been serving as interim as CEO since June. He, of course, will move on to his other role as COO, but Stephanie Linnartz, the new CEO of Under Armour. And we're looking at shares move in extended trading here, up just about 0.3%. And taking a look at Miller Knoll, that stock up just around 2.5% in extended trading. The company beating the street's expectations on both the top and bottom line. Third quarter profit guidance also better than expected. The company also saying that it sees annual expense reductions of approximately 30 to 35 million. Year to date certainly has been a tough go at it for the company, with losses of just about 53% over the past 3 months. So still looking at losses of about 70%, Dave.
Okay, Shauna, thank you. My stock to watch tomorrow is Carmax. The used auto retailer reports third quarter earnings before the bell tomorrow. Analysts are expecting adjusted earnings of 65 cents a share on revenue of $7.2 billion. Investors will be looking to see what the company says about demand and pricing for used cars, which has started to show some weakness. The stock is down more than 50% year to date. Coming up, the metaverse has been dragging down tech stocks this year, but companies are still banking on it for 2023. We have the biggest trends for next year after the break.
2022 has been a tumultuous year for tech. Now, the tech-heavy Nasdaq falling about 30% year to date. A slew of layoffs from companies including Meta, Twitter, Salesforce, all worrying investors. Even Amazon and Apple have slumped this year. Amazon's down nearly 50%, while Apple shares have slid almost 25%. Each of these companies, though, have their own ideas on how to turn it around next year. And here to break that down, we have our two tech reporters, Dan Halley and Ali Garfinkel. Great to have both of you. Lots to get into here. But Dan, let me start with you just in terms of one of the hot topics that we have talked about time and time again has been the metaverse. What can we expect there in terms of maybe more excitement? Because I think largely it's been a bit of a disappointment this year.
It's a big
maybe I'm being unfair.
No, it's a big fat goose egg so far. That's the way I feel as well. But the excitement comes likely from Apple announcing their new headset in 2023. We're expecting them to drop that at some point in the second half of the year. This is supposed to be one of the most advanced headsets that will launch. It's going to have an array of cameras, one of the best displays that's been available, and it should blow away the likes of Meta's Oculus 2, as well as Sony's upcoming PlayStation VR 2. So this is going to be one of the big announcements that we should see. And if anything, they're not so much leaning into the metaverse idea as the idea of AR and VR. You won't hear Tim Cook most likely utter the word metaverse at any point. They're trying to make it separate from that idea of legless, avatars running around in this virtual world that Mark Zuckerberg has set up. But, I do think that for Apple, this does represent an opportunity as well as a risk. The opportunity being, look, they have another product that could be another flagship alongside the iPhone, something they've been trying to accomplish for years. Everything right now is complementary to the iPhone for the most part. They do have this opportunity available to them. It could be a new kind of computing. That's what the boosters say. The flip side, though, is it continues to be uninteresting to consumers, and we don't see a good number of sales out of it. Pricing for this, according to Bloomberg, is going to be somewhere around the $3,000 range. So, it's not going to be for everyone. It's certainly more than a PS5, but, it could do Apple some good if it can get into this space. Yeah.
Dubious about the metaverse. I am super psyched for ChatGPT. Ali, I think this has implications from everything from the high schoolers and the college kids and how they do their homework to how Google may or may not dominate search in the future. What's coming?
Dave, I think it's worth saying off the cuff that this was the year, contrary to the metaverse, right? This was the year that AI really crystallized in the public consciousness. And of course, we have a couple of examples of that, but most of them are from OpenAI, which developed ChatGPT. So it's worth saying just off the cuff, number one, people are interested. That's something that we have absolutely learned this year. So in the case of ChatGPT, right, it can do all sorts of things, right? For those who are uninitiated, it's the most sophisticated chatbot that we have ever seen on the market. And it's like for instance, today I had it write a sonnet about what it expects to see from 2023. It was very optimistic. I'll let you all read that on your own time. The other thing too, before we talk about the benefits and drawbacks of ChatGPT, though, Dave, is that DALL-E was also developed by OpenAI, and it emerged this year. I actually gave it a prompt that you guys could see. This is a corgi on a throne in a blue smoking jacket in the style of Monet. So both conversational AI and AI art really made a dent this year. And as you said, Dave, benefits and drawbacks, right? On one hand, it could change the search landscape down the line. I'm very hesitant about that in the immediate term, especially because ChatGPT right now is only updated to about 2021, I believe. So anything you asked about 2022, for example, isn't going to be accurate. That said, it's also important to talk about, the drawbacks. For instance, one of the big ones you said, fears that it can help kids cheat on homework. But in the end, I think it's worth saying that this has captured imaginations of people worldwide. It's facilitated hate, it's facilitated love, and I think there's no doubt everyone's looking around saying, how can we leverage this in tech and otherwise?
Capture imagination certainly has captured Dave's attention. He loves talking about it. Ali and Dan, thanks so much for breaking that down. Again, you can read their article on yahoofinance.com. Next big thing in tech, 5 things that you need to watch in 2023. All right, well, coming up next, we have some of the hottest toys this holiday season here with us on set. It includes Dave's Jurassic World T-Rex quad. If he doesn't break it before then, we've got to look at it when we come back. The season of gift giving is here, and parents, if you're like me, you're looking to buy your children some last-minute gifts. I'm far from done for my holiday shopping. You don't have to look any further. Toy Insider's Holiday Gift Guide, breaking down the hottest gifts to buy your kids this year. We want to bring in Ali Murjeski, Toy Insider's editor-in-chief. Ali, it's great to see you. So help us out, because I think many of us are still looking for some of those last-minute gifts. You're nice enough to send a number of your top toys this year. So let's make this simple for everyone, and let's start. We'll go by age group. So let's go from youngest to oldest from what you send. So if you have an infant like me, or maybe a 2 or 3 year old, two of the hottest toys. We have the Fox in the Box and also this quad.
Yeah, definitely. So both of these are amazing for our youngest kids. For those newborns, this is for kids ages 0 and up. I love Fox in the Box. It's a peekaboo fox that pops right out of here. This is by Gun, so everything is super soft, and kids are going to love this. It plays peekaboo. There's also a song mode where it will play Pop Go the Weasel, and as you can see, it's super cute room decor as well.
And what about the T-Rex, the Jurassic World?
And the T-Rex is perfect. You were doing a great job riding it.
I thought he was going to break it. I was a little nervous.
It's great.
It goes up to 2 miles per hour. It's safe. As you can see, it looks super cool for kids. But what I love the most about it, it's easy for them to use, just push button acceleration. Plus, it's got really fun chomping and roaring sounds to just round out that dino experience. So this is going to be a really, really great one for your youngest.
And best of all, no age limit, even 46-year-olds. 3 to 4-year-olds, there's some karaoke, and I'm sure they will be singing some Encanto. Tell us about that. And I have a Barbie dream house still in my attic. Tell me about these two.
Yeah, perfect. So we know that we're still talking about Bruno all these months later. This is the Encanto EasyLink karaoke machine from eKids. You just simply press a button on here once you hook it up to your Bluetooth, and it'll take you right to an Encanto playlist or right to a Disney playlist. So kids can belt out the hits. I think parents are going to get in on this one too. So this is really fun, features kids' favorite characters.
And what about the Barbie Dream House?
And Barbie is celebrating 60 years with the Dream House this year. So she's been in real estate for a long time. This one comes fully move-in ready with 70 accessories. It's got 3 floors, indoor and outdoor play spaces. As you can see, there's a dance floor, a pool, a really modern and updated kitchen. So I love this because it's 360-degree play. All kids can play with this at the same time. Perfect if you have a household with multiple kids in it.
Yeah, it's pretty big. You have to have a lot of space. That's
not great for a New York apartment.
Certainly not. Takes up too much. Thank God I guess I only have boys at this point. The toys tend to be a little bit smaller. All right, let's move on. The next age group up. So 4 to 5-year-olds, one of the hot toys this year, these LOL surprise dolls. I don't know much about this. Why are these so popular?
Yeah, well, look how fabulous they look, first of all. So these LOL surprise, these are the OMG fashion show style dolls. They come in both style and hair edition. So you can see that they have super fun hair play. They come with great accessories. There's all kinds of fashion outfits they can swap into. Plus there's 4 amazing ones to collect. Kids are absolutely going to love these.
And finally, we're speaking my language with a little football here.
I don't know exactly how to use it.
Now, we'll see if Shana gets this thing to work, but what is it? What's the idea?
So this is the all-pro passer. This is the perfect quarterback, right? So this is a robotic quarterback. When you turn it on, you can pick the play that you're going to use. You turn it on right on the side. You use the arrows to pick the play that you're going to use. Then you're going to pump that hand pump with the football loaded on. Once it gets to how far you want to hit it, you hit the hike button and it goes up to 25 yards for the perfect pass every time.
25 yards up in the air. That's fantastic. All right. We're going to have to get ours to work.
We do.
And play in the studio.
Yeah,
here.
it's a little, we're struggling a little bit to figure out all these toys. There's so many. Ali, in terms of, I guess, what's jumping out to you this season, the hottest toys, how it differs from what we saw last year, what do you make of the trends so far in 2022?
So we know that this year, all families are looking to save a little bit of money, even when they're doing that last minute shopping. So the Toy Insider has a great 12 under 12 list in addition to our 12 under $20 list, in addition to our hot 20 list. So that also features a lot of hot toys like popular games and activity sets that are really great for kids of all ages as well. And everything on there is under $20. But I think a great trend when you're holiday shopping, especially if you're last minute shopping or shopping for those kids you don't really know that well, is go for their favorite characters. Go for those classic brand names that you know. Like I think on set there, you have a Lego Super Mario Adventures with Peach set, which is perfect because kids love Mario, kids love building. We have another great set there, the Squirgles building set. I love that one because it's magnetic building, easy for multiple kids to use. They can build up any kind of structures and the whole family can get involved in that. Same thing with the Pokemon Battle Academy for the trading card game where kids are learning how to play the Pokemon game, or mom and dad can learn how to play the Pokemon game so they can get in on the fun as well. So I really love picking items for the whole family, or those great activity kits. Like you see the Pika 3D Super Pen right there, which is an amazing 3D printer pen. Kid accessible, and it'll keep them busy for hours.
Ali, real quick, speaking of mom and dad, kidults is the biggest area of growth for toy companies. Why, and what are they doing to cater to the older audience?
Definitely. So companies are definitely looking to do that. And a big trend this year is retro brands. So we're seeing a lot of things like the Barbie Dreamhouse, like those Pokemon toys, things like Light Bright and Koosh Balls are all making a huge comeback that parents and adults are loving to see. But they're also designed for them. So Lego has a whole 18 and over line as well that is just builds for adults. So you can really get that calming Lego build in, escape from the world for a little bit, but also build something that you're interested in.
Check out the Toy Insider for more information. Ali, thanks for being here. Merry Christmas to you. And that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 o'clock Eastern Time, for all your coverage leading up to and after the closing bell. Merry Christmas, Shana.
Merry Christmas.